All right, good morning, everyone. So usually I start off higher level courses with a review of time value money, just in case y'all don't remember it. I should have done that last class, so in future semesters I will definitely be covering this on the introductory day. So we're going to be talking about some foundational concepts in finance that tie into everything that we're going to be doing with financial statement analysis, and that are just generally important for you to understand, not only as finance majors, but also going and working in the field. Right, this is a very practical field, and the stuff we might talk about might just seem like an academic exercise, but it directly translates into work you'll actually be doing in the field. One of my neighbors was one of the banking regulators for the state of Tennessee. He graduated from here. It's pretty fun talking about how when he was a student, he also thought like, oh, these are just practice examples professors are throwing at us, don't really have any real world application. But now that he's actually going through financial statements and applying pretty much everything we're going to be talking about, this isn't just a practice for the sake of giving you a difficult exam. It's stuff you're actually going to be using when you start working in the field. All right, so start from the very beginning, right? What is finance? Broadly speaking, it's the artful science of valuation and funding. Those are the two things that we are broadly concerned about, and everything that we focus on basically condenses down to those two items. How much is something worth? How are we going to pay for it, if it is worth paying for? Right? That's what everything comes down to. Everything that we're going to be talking about in this class is going to boil down to, are we valuing something, and are we going to purchase it? Are we going to sell it? Are we going to keep holding on to it? That's basically what it all comes down to. Right? And living in the uncertain world that we do live in, basically what this field does is it gives us a framework for making decisions. Right? We don't know exactly what's going to be going on in the future, but we can make decisions today that are likely going to benefit us moving forward through the future. Right? And that's basically what our field does. We take some assumptions, use them to put into our estimates, and then try to make good decisions using this framework that financial economics provides us. All right, so very typically, we're looking at this from the perspective of a firm, right? A company that's a for-profit business that produces goods and services. And the goal, at least theoretically and optimally, is that the company is trying to maximize value, residual value, like we spoke about last class, the free cash flow that the company is going to be generating, right? And they do so by investing in value-adding projects, but also reducing inefficient costs. And the way that we figure out those value-adding projects is basically through a similar process of financial statement analysis that we're going to be looking at for companies as a whole. Right? Every single project that companies engage in build up and end up in the financial statements that we evaluate. Right, so our roles as financial managers, there's basically three policy levers that we have that can increase value. The first and the most important is the investing policy that the company engages in. The capital budgeting, right? Figuring out how much is something worth, and then investing in that project to add value over the long run. Right, so a good example, Dell computers. You're all sitting in front of one right now. That was a result of an investment that the company made decades ago in developing their computer arm. Similar for the phones that you have in your pocket, for the car that you drive. Those are all due to companies performing some sort of investment analysis, figuring that it was going to add value, making that investment, and pursuing those projects that they're evaluating. So long-term investing is definitely the most important role, figuring out how we can add value through that. But another way that we can add value is through the capital policy of the company. Long-term financing, short-term working capital. With long-term financing, usually we're concerned with trying to minimize the company's cost of capital. Minimizing the cost of capital, everything else equal, will increase the value of the firm. Inverse association between the discount rates that we apply to cash flows and their present values. But we can also add value with short-term working capital management, right? It's become across the board popular for, prior to COVID, to have very lean inventory practices, right? Just-in-time production had become increasingly prominent. As we saw during the pandemic, though, that can lead to supply crunches that can really hamper companies' productivity. Right? So short-term working capital is another area that we can add value. And lastly, the dividend policy. Dividend policy is more about avoiding value destruction than actually adding any value, though. We'll see why in a little bit. So typically speaking, companies are going to raise most of their money from previous profitable years. About 70 to 75% of a typical company's investments come from previously saved up cash that companies have earned through being profitable, right? So most of the time when companies are making investments, it's coming out of their own pocket. But that other rough third of capital that's being used is going to come externally, either from banks, debt markets, or stock markets, raising capital through those. Right? And so those sources of capital are going to be on the flip side of financial statement analysis. Right? Banks are going to be looking at a company's financials to determine whether they're actually going to be worth the risk of lending them money. Same thing with debt holders, similar with equity holders, but what they are concerned with are slightly different each time. Banks are more concerned, does this company generate sufficient profits to be able to make the debt repayments that we owe? Very similar for bonds. Equity holders are more concerned with free cash flow in general because that is the metric that is being paid out to shareholders at the end of the day. All right, so bonds and stocks are typically the most common sources of external capital. They typically make up the largest proportion of external capital that companies are going to be using. Just quick breakdown of what those are. Bonds are basically just structured debt instruments, right? Debt is, I'm going to lend you money, you're going to repay that money at a given interest rate. Relatively simple. Stock is ownership in a company, right? You're an equity holder, you own stock, that means you're the owner of the firm. You're a residual claimant to the company's value that they're going to be generating. All right. The last recap is time value of money. This is one of the cornerstones of the field of finance. It is something that you have to be very familiar with as a major and as if you're going to work in the field, just as a financier. All right, so broadly speaking, the value of something is what you expect to get from it. The value of any asset is the expected discounted cash flow that asset is expected to be generating. Right? And it's important to understand, though, that value changes over time. When you look at cash, it is depreciating asset over time. You can purchase less holding the same dollar in your hand over time, right? It's a common trope. Grandparents, older parents will complain about things being a lot cheaper when they were younger, but that is true, right? $1 100 years ago would purchase much more than it could today with the inflation we've had just a couple years ago, right? We see the effect of inflation within the course of our lives, right? That's time value of money in effect. Dollars purchase less over time because economies tend to be inflationary when they're productive. There are other asset classes, though, such as equity, that if you invest in them, they should appreciate in value over time, right? If you were to hold a single share of Apple from about 40 years ago when they initially listed, you would have much more purchasing power with that share of Apple right now. They've been paying dividends, they've had share splits. The pure value of those shares has appreciated significantly since its publicly listing. So holding onto a share of Apple would leave you with higher purchasing power over the course of that time. Right, so asset values change, and what time value of money does is it gives us an equivalent basis to gauge how much that value has changed and what is a way to equivalate the asset values over time, or across time, I should say. All right, so we always have to adjust for time value of money because we need to know how much something is actually worth. Right, that's the cornerstone of our field. How much is something worth? If you're not adjusting for time value of money, then you're not getting an accurate picture of what something is truly worth. All right, so relative purchasing power over time. How do we actually go about making those adjustments? We have present and future value formulas. Present value, there's some value in the future. We're trying to figure out what that is going to be worth today. Very applicable to assets in any sort of investing, right? We have to forecast what we expect the future cash flows of an asset are going to be, discount them at whatever we think the appropriate discount rate is, and then that gets us our value for that asset today. A lot of time, money, and effort is put into figuring out asset values because the future is inherently uncertain. We don't know what the future cash flows are going to be. We don't know with precision what the appropriate discount rate is for many asset classes. So figuring out what the present value is a relatively lucrative field because we don't know what the future has in store, right? So a lot of time and money is put into figuring out asset values. It can also be used to in the opposite direction with future value. We have some money today. We estimate what it's going to be worth in the future. That's going to be something more like retirement planning, right? But these are the two perspectives of time value of money that we're generally concerned with. What something is worth today, how much should we be willing to pay for it, And how much, if we have cash today, what is that going to be worth in the future? Right, so these are the two general perspectives that we're concerned with in time value of money. Generally speaking, though, right, those two formulas were a single cash flow. Usually we're concerned with streams of cash flows over time. So we turn to discounted cash flow analysis. And all we do here is, this is basically exactly what we were looking at with the single cash flow with present and future values. But now we're just adding up each one of those discounted values in each time period. Right? So we're just extending this time value of money, we're just extending this present value to multiple time periods. And with financial statement analysis, basically what we're dealing with is trying to figure out what the appropriate cash flow is. Right? For those of you that had me in corporate, we started off with the simple present values and expanded over time, and by the end of the class, we saw that cash flows can actually get pretty complicated. And that's basically what we're going to be focusing on in this class, is putting together those cash flows and understanding how we're arriving at that value. All right. And the last aspect of time value money that you have to be familiar with is just putting together a discount rate. Right? For a company overall, it's usually the weighted average cost of capital, and this just reflects the external sources of capital and basically the hurdle rate that the company has to achieve. What's the minimum rate of return on investment, the return on invested capital that a company has to earn before they start adding value? Right? So this discount rate is what we use for the firm. Just important to keep that sort of thing in mind. So we're going to turn over to Excel now to work on some examples. Hopefully this is all just a review, but it sounded like some of you weren't too, you weren't remembering a lot of the time value money stuff when I asked about it last class. So we're just going to do a few quick examples and hopefully refresh your memory on this. All right, so present value, right? Present value is we're trying to figure out what something is worth today relative to the future, right? So let's say that we're going to receive $20,000 at some point in the future. What's that $20,000 going to be? So we do have those formulas that we have presented in the PowerPoint, but Excel also has built-in time value of money functions we can use. Right? Really great thing with Excel. Once you start using the functions, it also gives you the definition of what function you're using. Right? So we're using the present value function. It's returning present value of an investment, how much it's worth today. And then it's telling us what information Excel needs to calculate this present value. Right? So we need the rate, the discount rate that we're applying, the number of periods. We're skipping over payment because this is a single cash flow, and we're getting the future value. All right, so hopefully you notice the future value is put in as a negative value here. The reason for that is when we're using time value money functions, you need a negative sign on either the present values or the future values. It's just a character of the time value money functions. It's kind of just a historical thing that we've used in calculators. Kind of annoying, but just something you have to be mindful of. Right, so then I just copy and paste this formula over once I have that calculated, and now we're seeing the present value. Right, the further out into the future we receive this cash flow, the less that cash flow is going to be worth today. So just put in a lazy graph. No, that's not it. And over time, the further out into the future we receive that cash flow, the less that cash flow is going to be worth today. All right, future value is the mere opposite of present value. Now we have this $20,000 and we're trying to figure out, okay, if we were to save it up at 8% per year, what is that going to be worth in the future? All right, so we're going to use the future value function, FV. Same inputs, only difference here is we're using a present value instead of a future value. And like I said, mere opposite of present value. Right? Whereas present value, the further out into the future we receive that cash flow, the less it's going to be worth today. With future value, it's going to be compounding exponentially. And we can see better examples of this if we have higher discount or compounding rates that we're applying. So let's use 20% instead of the 10 and 8, and we'll see that exponential growth quicker. Right? So the more time you give money to discount or compound, or the higher rate that you're applying to those discount or compounding values, the more you're going to see that exponential effect. With present values, it's going to exponentially decline down towards 0. And with future values, it's going to exponentially grow. Right? So time value of money really shows us that even though we're dealing with the same nominal amounts, when you value that amount, has a direct implication for the actual value. So it's always important that we're adjusting for time value of money, because if you're not, you aren't evaluating a cash flow. You're not evaluating an asset on an equivalent basis. All right. Any questions on present or future values? All right. Yes. Mm-hmm. Here? 16,000? Oh, you mean the function? Yeah. So we're using the present value function. So whenever you're using a function, you start with the equal sign, and that's going to start. Basically, it's going to tell Excel that you're using an equation now. So we're going to use what's called the present value function. So you follow that equal sign with PV, and open up a parenthesis, or hit tab. And now Excel is looking for specific information. So we're using the present value function, which requires 3 inputs: a discount rate, the number of periods, and cash flows, future cash flows. All right, so in this case, we have the discount rate, we have the number of periods, and we're using the future value because we're dealing with a single cash flow, a single $20,000 lump sum. So we put in our rate, the number of periods, another comma, skip over payment with an additional comma, or you can explicitly put 0 in there. Either way, it'll get you the same answer. And then future value. And so that's how we use the future, or the present and future value functions here. All right, so present value, we're receiving a future cash flow and trying to figure out what that cash flow is worth today. Future value, we have a cash flow already, and we're trying to figure out what that is going to be worth in the future. Any other questions? See a couple people talking back there. Is there anything you're uncertain about? So I take it this isn't a refresher for some of you, at least using Excel? All right. I'll post some more information on using Excel and just things you can practice off of. Is corporate a prereq for this class? It is, right? No? Principles of corporate is. Okay. All right. All right, so I'll post some more information on general Excel use and time value money problems. This is definitely something that you should be familiar with. It's not something we'll be directly working on in this class, but it's something that you will be using, especially in your capstone course. So very important that you're familiar with it. We are going to be using Excel a lot, but time value of money functions specifically not so much. Yep, and if any of you have any questions while I'm going along, I have a tendency to go relatively quick, so you can always ask me to slow down, repeat something. Right, I'm here to teach y'all, so don't want to miss that opportunity. All right, so we're going to start expanding time value of money a little more here. So the functions that we just use assume annual compounding, but typically that's not the case, right? Typically you're dealing with more frequent compounding periods, right? So for example, if you're saving up, contributing towards your retirement, typically you're not making that contribution once a year. Typically it's coming out of your payroll on a weekly, bi-weekly, monthly basis, right? So if we were to just use the time value money functions as we just did, it's assuming annual compounding, but typically it's more frequent than that. So let's see, if we have a $1,000 investment earning 10%, what is that $1,000 investment going to be worth after 35 years? All right, so we're going to start off with just the annual compounding that we've already used. All right, so we're going to put in our discount rate. We're going to put in the number of time periods. Oh, make sure I fix that reference so this keyboard's a little funky. Hit F4 to fix reference. So whenever you're dealing with Excel, it's usually going to be, its default is a relative reference. All right, so let me just redo this whole thing so I can give you an example of that. All right, so if I were to put all this information in, get our rate, period, and future value. All right, we're correctly getting this compounding value after 35 years, but if we were to copy and paste this over, right, it's referencing information that's 2 rows up and 1 column over, right? And if I were to keep copy and pasting this over, that relative reference is going to remain the same, right? But because I have explicit information that I want to hold on to, I'm going to use fixed references, right? So what fixed reference does is if you're on Windows, you just hit F4, or you can manually type in a $sign before the column and the row. And what this is going to do now is fix the reference to these values. So it doesn't matter where in the workbook I copy and paste this formula, it's always going to reference these same values. All right. So I have the fixed references set up now. Now we'll adjust for compounding. All right. So when we're adjusting for compounding, I have a little reference here. If we have a payment, we divide it by the number of months. Well, we do have a discount rate. When we have a discount rate, we divide it by the number of months, and the number of periods, we multiply it by the number of months. Yes, question back. I'm sorry? Zoom in, yes. Better? Plenty of computers up here too. I have bad eyesight as well. But yeah. There we go. All right, so we have the same formula set up. The only difference now is we're going to have to make adjustments for the number of compounding periods. All right, so basically what we're saying here is that we have 2 compounding periods per year in this first one, right? So we have the $500 to start, and then another 6 months compounding after that. All right, so in order to make that adjustment, we'll just divide by the number of compounding periods. The number of payments is going to be multiplied by the number of compounding periods. And we don't have to make an adjustment to the present value because this is a lump sum. It's not a payment. All right. So from going from just a single compounding period to semi-annual compounding period, we're adding $2,000 in our portfolio value just from compounding a little bit more frequently. All right. And we're going to see that as we increase the number of compounding periods, we're going to continue adding value. Right? So if we go from an annual compounding period to a 12-month compounding period, it's increasing our portfolio value by $4,000 over these 35 years just from compounding a little bit more frequently. All right, so the more frequently we're compounding on our investments, the more value our portfolio is going to be worth by the time we reach retirement. So now we're going to look at portfolio values monthly, saved up every month, right? So let's say that we're saving up $1,000 per month over the course of a year, and we're investing it in a diversified portfolio earning an average of 6.5%. All right, so what's this portfolio going to be worth after 20 to 60 years from now? All right, so we're dealing with the future value problem. We're concerned with, we have a savings amount. What is that amount going to be worth at some point in the future? Right? In this case, something like retirement planning. So we use the future value function. We have our rate, right, adjusted for monthly compounding. We have our number of periods. Fix that as well. Have our number of periods. We're going to let that fluctuate because we want to change how many years we're evaluating this portfolio at. Also divided by number of compounding periods. And now we are dealing with a payment, right? We're saving up $12,000 every year. This isn't a single lump sum. We're saving it up every year. So we're saving up $12,000. Remember to get that negative sign on there. You need negative sign on your one of the cash inflow or outflow. And that's going to be divided by 12 because it's $1,000 saved up every month, right? So 12,000 divided by 12, $1,000 per month. Fixed reference in those last periods. Oh, and I messed something up. We have the rate. Periods. Oh, that's what it is. I divided it instead of multiplied. There we go. There we are. Right. Really easy to make little mistakes like that as you're going through Excel. It'll happen as you go through it as well. Just make sure that you're going back and double checking, because usually you'll get some nonsensical results, right? Like in this case, the value I got was less than 2 months worth of savings. Obviously that's not correct. So it told me something I input was incorrect, and it was in the months. All right, so what we're seeing here is if we save up $1,000 a month and invest it in a portfolio earning an average of 6.5%, over 20 years, that portfolio is going to grow to $490,000. All right, but how much did we save up over this time? All right, so this nominal value is just how much we're purely saving up. We're not investing it or anything. It's just how much is coming out of our pocket. All right. So over those 20 years, we've saved up $240,000. But right off the bat, we're already getting more than double our savings amount just from the compounding power from our investment portfolio. And that's what we're looking at in this ratio down here. The future value to the nominal value is showing us how much our portfolio value has compounded relative to how much we have saved up. All right, and as we start copying this over, we're going to start seeing some real exponential growth. All right, whenever you see those number signs show up, that just means there's more information than Excel can physically express in that cell. So you can double right click on the column and it'll automatically expand. All right, so if we go from saving over 20 to 30 years, we've nominally saved up another 120,000, right? 10 years worth of $12,000, 120,000. But our portfolio value has gone from just under $500,000 to just over $1 million, with just one single additional decade of saving up. But now what's going to happen is we're going to start seeing some real exponential growth going on in that portfolio value. Even though we're just saving up $120,000 more every decade, we're adding millions of dollars in portfolio value from the exponential growth of our investment. All right, so we'll just keep copy and pasting this over. All right, so if we were to save up $1,000 a month over 60 years, that's a very long career, but who knows, right? Medical advances, maybe we will be living that long into retirement. Or if we save up $1,000 a month over 60 years, that's going to compound to $8.8 million, relative to a nominal savings of 7.2. Right? And so we can really see that exponential growth going on here with this future value relative to the nominal value, because right, how much is our portfolio value scaled to our savings? Right? And this is the effect of compounded returns, right? If we were to have a riskier portfolio weighted completely toward equity, earning something like 8%, only earning 1.5% more per month, right? But that 1.5% can result in, again, millions of more dollars saved up over the course of our career. Right? So very, very important. As soon as you're out of school, as soon as you're able to, start saving and investing your money, because time is the most important aspect. Time and investing in appreciable assets are going to be the best benefit that you can receive, not only understanding finance, but over the course of your whole career. So as soon as you're out of here and start earning something, I strongly recommend you start saving and investing right away, because that's not something you can undo, right? You can't hop in a time machine and tell yourself 10 years ago to have started investing. That's a decision you have to start making now when you start your career. So very strongly encourage all of you to engage in that. Any questions on this table? Okay. All right, and the last time value of money example that we're going to look at is a present value, right? So here, let's say that we're evaluating a project expected to generate $550,000 over 3 years. What is that project going to be worth today? So we'll set up the cash flows. right, now we're going to set up the discount factor. So right, when we're dealing with present value, right, we have our future value divided by our discount factor, 1 plus the discount rate raised to the number of years. But that's also just equal to separating out the future value from this discount factor. And one important thing that you're going to learn, especially in this class, is the separation of information before we aggregate it all into something relevant. Right? So when we deal with cash flow tables, we want our cash flows in their own rows, and we want our discount factors we're applying to those cash flows in their own rows as well. We're going to be combining them, yes, and we can calculate this in a single cell, but we want to explicitly show the information that's going into each of our steps. As we're going to see, I think 2 classes from now, breaking down that information is absolutely vital to understand the inputs to the output that we are observing. Every decision that we are going to make, every decision that a company engages in is going to have some effect on the cash flow that they're generating. And it's important that we disaggregate that information so we can see where exactly those decisions are having positive or negative effects. All right, so it's important that we understand that the reason that we are using cash flow tables like this is so we can disaggregate the information to see what is going to be relevant. All right, so we're going to get our discount factor here. The discount factor is just the 1 divided by 1 plus our discount rate. In this example, 8% raised to the year. And as we'll see, as we copy and paste this forward, it's declining. And the further out into the future we receive our money, the less that money is going to be worth today. And just as an example, if we were to put that in time 0 today, the time we're trying to get this estimated value, anything that we receive today is worth itself. Right? So $1 today is worth $1. It's not the case $1 10 years from now is worth $1 today, but $1 today is worth itself. All right, so now we're going to get our present values, just multiplying together the future value and that discount factor. All right. So this 550,000 received 1 year from now is estimated to be about 510,000. Yes. So my guess would be you didn't fix the reference to the discount rate here. So if you fix that reference and copy and paste that over, that should correct it. Did that fix it? Cool. All right, let me check that out real quick. Excuse me. Can you highlight the cell? Oh, you didn't raise it to the year. Yeah. So shift caret. There you go. And then raise it to the year that it's in. There you go. Enter. Now copy and paste that over to the other cells. Yep. Yep. All right, any other, got to finish the example. Right, so this 550 received 1 year from now is worth about 510,000 today. Received 3 years from now, it's worth about 440,000. Right, so the further out into the future we receive our cash flow, the less that cash flow is going to be worth today. So the sum value of all those cash flows now is just the sum of those present values. All right, and so this is basic setup for why we engage in present values. If the cost to invest in this project is $1.5 million and the expected value of the project is $1.4 million, should we make the investment? No. Be confident. No. We're expected to lose value if we were to make this investment, right? Basically what this is saying is if we have an expected value of $1.4 million from the investment, if the cost of investment is $1.5 million, then we're losing about $85,000, $83,000. Right? And that's the point of looking at present values. How much is something worth today? What is it worth? And what does it cost? Right? And so that comparison is what we're trying to get out of these problems. What is something worth? How much should we be willing to pay for it? Right? There's always a difference between value and cost, and it's important that we keep that in mind. Right? When we apply present value principles, that's what we're trying to do. How much is something worth? Compare it to cost of access. Make our decision. So is this worth investing in? No. We're expected to lose value if we were to make this investment. Value of money? Okay. So like I said, you're not going to be directly tested on time value of money so much in this class. But it's incredibly vital for you as a major, as someone that's going to be working in this field. I'll put up some more workbooks for you to work through if you feel you need some more practice on this. I'll also send some links that to some websites that will go into some more details. I could probably just link some of my PowerPoints and videos as well from other classes because it's important that you're familiar with this. Right? We're not going to be directly working on time value of money, like I said, in this class specifically, but it all ties together with everything else we're going to be doing. Right? This class is pretty much about finding out what that future value is, putting that information together to estimate those cash flows and getting details about that. But really, what it is tied into is understanding the present value and being able to apply discounted cash flow analysis. All right, so the last thing we're going to review in this sheet is free cash flow and looking at how different aspects of managerial control can add or destroy value. Right, so free cash flow is a really interesting topic for a few reasons. One, it's the bottom line goal, or should be for a company. How much value is being created or destroyed, that is being generated through free cash flow. Or that's how we are going to be measuring that value. Oh, and I think I forgot to point out, all the Excel sheets that we'll be going over, all the PowerPoints, they're all listed under the PowerPoint here, so you can always have that available to you. All right, so free cash flow has several ways to measure it. The bottom-up approach is one of the most popular methods. It's one of the easier methods. That tends to be the case. The popular method is going to be the easier one. Technically not the most accurate. Most accurate would be the depreciation tax shield method of measuring free cash flow. But usually they should get you a very, very similar approximation of a company's free cash flow. So the bottom-up method, basically what we're doing is we're starting at net income and then adjusting for cash or non-cash changes that the company is actually engaged in. Right? So the first thing that's being changed with the bottom-up approach is depreciation and amortization. And we're adding back any depreciation and amortization that the company has paid out. Depreciation and amortization are pure accounting expenses that companies don't actually have any cash outflow from. Right? So the example I always like to use with this is when you buy a new car. What happens to the value of a car when you drive it off the lot? It decreases. Yeah. When that value decreases, are you throwing money out the window? No, it's just the nature of the asset value. When you start using a car, it loses value. You're not paying cash out of pocket. You're not throwing your wallet out the window. You're not paying somebody for this value reduction. It's just the nature of using an asset. Assets decline over time. When you use a computer, it breaks down over time. I had a really old, crappy computer I've had since grad school I finally replaced. Oh, I am so excited about it. It is such a powerful computer. Every time I boot it up, it's the best. Assets decline over time. They lose value. It's the nature of using things. Depreciation is the accounting expense of that asset value reduction. It's not an actual cash outflow. Companies aren't actually paying someone for their asset value reduction. It's just the nature of using assets over time. So depreciation and amortization is a pure accounting charge. It is not an actual cash change in the company's position. Right? It's not a cash outflow. So the first thing we're adding back in the bottom-up approach is depreciation and amortization because it's an accounting expense. It is not a cash outflow from the firm. The last two things that we're subtracting now are actual cash changes in the firm. When you purchase that car, that is cash out of pocket. Right? If you're taking out a loan, that's a liability that you're taking on. Cash is actually going out of pocket when you purchase that car, when you purchase that computer. So CapEx is taken out from net income because capital expenditures is an actual cash outflow from a company. Same thing with change net working capital. And we'll get into more details about those two items later on. But change in net working capital is basically cash being tied up or freed up in the short run production process. Right? So cash gets tied up with something like accounts receivable. You make a sale on credit. You haven't actually received the cash for that, and you're going to receive that cash sometime in the future, hopefully. Right? On the flip opposite of that is accounts payable. Right? You purchase some input to your production process. You haven't actually paid that cash out yet, but it's just freed up a little bit of cash from having that increase in accounts receivable. All right, so bottom up free cash flow, we start with net income. We add back depreciation because it's not an actual cash expense. We net out capital expenditures and change in net working capital because those are actual cash changes in the firm. All right, so we're going to put this all together in some quick examples here just to see what happens to the change to the free cash flow. So free cash flow is our net income plus depreciation and amortization minus capital expenditures minus the change in net working capital. All right, so we'll have current assets minus current liabilities minus previous period's current assets and current liabilities. All right. So if we were to say shorten collectibles and lengthen our credit cycle, so in other words, when we make a sale on credit, we're getting that money back sooner. And when we purchase something on credit for making our product or service, we're taking a little bit more time to pay that off. We can copy and paste this over, and we'll see that our cash flows increased a little bit. All right, so working capital management is one of those areas that financial managers can have an effect on a company's value. Managing collectibles, receivables, payables, that can add value. They're little bits of value, but over time it can add up. Any questions on calculating free cash flow? Okay. All right, so companies are, let's say, hypothetically, always engaging in value-adding processes, right? So how are companies going to grow through those processes? And basically, there's internal and external growth. With internal growth, companies save up their cash over time and invest in more value-adding projects and continue that virtuous cycle of increasing value. They can also go to capital markets, which typically are what companies do earlier on in their life. It is true that old established companies can add value by going to capital markets as well. We'll see if we have time for that discussion toward the end of this class. Probably not, but we'll see. But these are the two basic ways that companies are going to be growing. Internally through increased cash flows, externally through raising capital. All right, so let's put some of this information together now to start looking at what is the effect on value through the different policies that are available to financial managers, right? Investment policy, long-term capital policy, WACC, discount rate management, and dividend policy. All right, so we're going to start off with our base value here. All right, so the value of any asset is the discounted expected cash flows. So we take the next period's cash flow. Right, we're only dealing with future cash flows. 1 plus our growth rate. Actually, I'll put another parenthesis around this just to make sure we're not messing that up. And divide it by our growth adjusted discount rate. So just should probably remind you of this formula, right? The value of a growing perpetuity is equal to the cash flow in the next time period divided by the growth adjusted discount rate. Right? Whenever we're dealing with the perpetual asset value, which tends to be the assumption with equity, we're dealing with a growing perpetuity, and in its terminal time period, its value is going to be equal to the next period's cash flow. So 10,000 times 1.05 divided by the growth adjusted discount rate. So that 5% growth rate minus the 8% discount rate, the weighted average cost of capital. Okay. So that brings us to the value today. We can also get the same value by getting the operating profit. I always forget what the operating profit formula is. That's why we have formulas. Profit, growth, bless you. All right, so we take our operating profit, multiply it by 1 minus the growth over, growth over return on invested capital. Make sure I get the same value of the cash flow. And we did. All right. So now we divide this by our growth adjusted discount rate, and we should arrive at the same answer as our cash flow value. Oh, I forgot to grow this. That's what I missed. There we go. All right. So this is going to be our base case scenario, right? We have 20,000 operating profit, 10,000 reinvestment, 10,000 free cash flow. Our average growth rate is 5%. Our retention ratio, so the retention ratio is how much of a company's profit are they plowing back to be invested in the firm. We have our return on invested capital, so for every dollar invested, this is our return for that investment and our discount rate of 8%. Question in the back? Yeah, so I forgot to get the next time period's cash flow. Right, so the perpetuity value is the next year's cash flow relative to today. So this $10,000 is this year's cash flow. So we're growing it by the 1.5% this growth rate. Any other questions? All right, so now we have our base case scenario. And we're going to see what happens under different situations that financial managers can have control over. So investment policy, right? Pursuing a strong investment policy will result in an increase in the growth rate of the company. In other words, the return on invested capital will be increasing, right? Optimally, that's how managers are going to be working. They're going to be continually pursuing value-adding projects that are going to increase our return on invested capital. All right, so relative to our base scenario here, what's going to happen to the firm's value as we increase our return on invested capital? Everything else equal, it's going to result in a higher firm value. All we're doing here is copy and pasting those values that we started off with. On the flip side, if management has been slacking and they start throwing their money into poor projects, that's another side discussion that there are, unfortunately, a lot of incentives in real life for managers to pursue poor return on investments for their own personal benefit, but that's a whole other topic. But if the company starts going down that pathway of pursuing lower return on invested capital projects, they're going to be reducing value. Right? We can see that right off the bat. As soon as you reduce your return on invested capital, you're reducing the value of the firm. Capital policy, managing a company's discount rate. There's always an inverse association with present values and discount rates, right? Just mathematically, that's the nature of it. You increase the denominator, you're reducing the value of the fraction. So as our discount rates increase, they're reducing our present values. In other words, reducing the value of the asset. So if we were to reduce our weighted average cost of capital, the discount rate that we are applying to these future cash flows, we're going to be able to increase the company value. Right? There can actually be a tremendous amount of value increase or destroyed from changing a company's cost of capital. In reality, though, management don't have much control over the discount rate of the firm. Right? They have a little bit of control by managing their debt to equity ratio, but it typically doesn't result in drastic changes in the discount rate of the firm. All right, so reducing the company's cost of capital is going to increase the company's value. On the flip side, if the company doesn't do a good job managing their cost of capital, they can destroy a lot of value as well. Right, investment policy, capital policy, these are the two largest changes that companies can make to increasing value. Dividend policy is more about typically not destroying value. Right, so over time, companies can be in a position where they just accumulate so much cash that they don't know what to invest in. Apple was a really good example of that. Over time, that company is extremely profitable. It's generated a huge return on investment, and it just started stockpiling cash. It didn't have any investments that it had in the foreseeable future to use that cash in an efficient way that's going to generate a positive return on invested capital. So shareholders started voting and demanding that rather than just sitting on these piles of cash, you should return this money to us. Right? So if a company is in a position like that, that is kind of a good way to manage, to start dealing with paying out dividends. But earlier in public market history in the U.S., it used to be relatively standard for companies to pay dividends. Right? But as we'll see here, increasing your dividends is not always going to be a good way to increase value. So in this example, the company has a 50% retention ratio, meaning 50% of profits are being retained within the firm. Broadly speaking, the best way to deal with any retained earnings is if your return on invested capital is greater than your cost of capital, you should retain as much, if not all, of your income in order to increase value. Right? And that's kind of just the example that we're seeing here. If the company increases the retention ratio from 50 to 75%, so rather than paying out 50% of net income as a dividend, you're only paying out 25%, it's going to increase the company's value. But that's going to be the case if return on invested capital is greater than cost of capital. Right? So on the flip side, if return on invested capital is greater than WACC, and we reduce our retention ratio, that's going to reduce the firm value. On the flip side, if we happen to have a return on invested capital that's lower than our cost of capital, then increasing our retention ratio is destroying value. Whereas reducing our retention ratio is going to destroy value a little bit less. Right, so in reality, dividend policy is more about avoiding bad return on investments. If your return on investment is lower than your cost of capital, you should be paying out that additional cash and dividends, the additional profits. All right, so investment policy, capital policy, dividend policy, those are the main areas that financial managers have control over the company's value and how they can add value over the long run. Investment policy, by far being the most important one. If companies don't produce products and services that people want, it doesn't matter what the dividend policy, it doesn't matter what their capital structure policy is, they're not going to have the revenues to support the company over time. So a solid investment policy is necessary for companies to survive, let alone thrive. On the flip side, capital policy, typically it can add a little bit of value over time. The bigger issue is not over leveraging the company and making terrible decisions that just lead to financial ruin. Right? So capital policy can add value, but more it's about avoiding poor decisions than making good ones. Similar with dividend policy, but to a lesser degree. Any questions on time value of money or cash flow? All right. I know this was kind of a lot for the review. It sounds like some of you did not have much exposure to using Excel with time value of money. So again, I'll get as much information as I can posted in a separate section on D2L for you to practice and kind of go over on your own. We will be going through cash flows a lot in this class. So we'll be revisiting stuff on this page. But time value of money is kind of, it's one of those core things that I feel like everyone should know, especially in this field. So wanted to cover that. If there aren't any other questions, all right, we'll get back to some more financial statement analysis then. All right. So what is financial statement analysis about? Like everything else in finance, it's about making decisions. Specifically, we're going to be using companies' information from their financial statements, combining it with potentially other relevant information to make decisions. Right? There is a lot of information contained in companies' financial statements, and you're going to see that as you go through your project. There is, to an extent, a lot of information that you don't really need to value a company. But that information is there nonetheless. And one of the more important things to take out of this class is basically filtering through what is relevant information and what is not necessarily relevant to your bottom line decision. Right? My personal philosophy is somewhat reductionist in that I go straight to the bottom line cash flows that companies are generating. When I'm valuing companies, what I look for is straight at the bottom line cash flow. Everything else is extraneous until that point. When you want to figure out what something is worth, you look at the cash flow that they're generating. right? And you start adding in information from there that might be relevant to this decision. Right, so there's three broad financial statements that we're going to be using: the balance sheet, the income statement, and the cash flow statement. Those are going to be the most important ones. There's other information that might be relevant in the broad 10K reports that you're going to be looking at, but those are going to be the three most important across the board. All right, so the balance sheet reflects the assets and liabilities of a company. Basically what that means is where cash came into a company through the liabilities and how that cash is allocated within the firm. All right, so liabilities reflect source of cash, right? When you hear liability, typically you think, oh, that doesn't sound too good. But really what that means is it's a source of capital to the company that they can use. It can come through external sources, through raising debt. It can come through internal sources, through saving up previously profitable years. Over time, value-adding companies should see a growth in their liabilities naturally just from the increase in retained earnings from previous profitable years. All right, and one important accounting identity to always remember is the basic balance of a balance sheet. Assets plus shareholder equity equal assets. That is always going to be the case in historical financial statements. As we'll see when we start looking at pro forma financial statements, it's not necessarily the case when we forecast financial statements, but historical data, balance sheets are always going to be balanced. Assets equals liabilities and shareholders' equity. That is by construction. Right? We're going to be looking at the dual ledger system. Every time there's an entry on one, there's an offsetting entry on the other side of a balance sheet. It balances. One of the nice things about this field is a lot of the phrases aren't too creative, right? Often the definition is in the name itself. Balance sheet, it balances. So this is the basic structure of balance sheets. We have liabilities on the right-hand side, assets on the left-hand side, both in decreasing liquidity, meaning how readily convertible is this item to cash. Right, so looking at assets is the easiest way to look at that because cash is already cash. It's already been converted into itself. Right, so from here we start decreasing in liquidity. So we go from cash to other short-term assets, so such as accounts receivable, right? Sales that we've made on credit that we expect to receive cash inflow from at some point in the future. From there, we have inventories, things that we've already produced that we plan on selling in the near future. Property, plant, and equipment, large assets that companies invest in order to support their revenues, and intangible assets such as IP and patents and such. That is where cash is parked in the firm, or I should say capital is parked in the firm. Right? Every time there is a cash inflow to a company, anytime the capital increases, it's going to be parked somewhere on the asset side of the balance sheet. Right? So assets reflect a use of cash, where that cash is housed in a firm. Liabilities show us where that capital is coming from. Right? It could be working capital that's used directly in the production process through accounts payable. Right? Again, that's going to be something used in the production process that we use but haven't paid for yet. From there, that brings us to our debt section. So short-term, current portion of long-term debt and long-term debt. And then finally, shareholders' equity in the bottom right. Right? Equity raised from issuing common equity and retained earnings, saving profits from previously profitable years. And again, value-adding companies should see their retained earnings naturally increasing over time. Next, we have the income statement, right? What's showing us the revenues through the profits. Income statements are also structured in a very similar way. You start with money coming into the company, then take out all of the expenses and taxes, and arrive at the profits at the bottom. Very similar structure. As you're going to see when you turn from just these blanket examples to actual companies' financial statements, there's going to be some little detailed differences, not only between these two examples, but also across firms. Right? Companies have different things that they report in different areas, and they have some degree of leeway on how they choose to follow those reports. So you are going to see little slight differences, but the structure is generally this way. We have revenue at the top. From there, we net out our cost of goods sold, costs that are directly associated with generating that revenue. So, for example, Starbucks, if you're making coffee, the coffee beans that go into brewing it are a cost of goods sold, right? Which arrives us at gross profit. From there, we net out selling, general, and administrative. That would be like the branch manager salary at a Starbucks. They're not directly tied to producing that cup of coffee that was sold, but they're generally a part of the operation of the company. Which brings us to operating profit. And if you remember, this is one of the steps that we might be looking at cash flow depending on how we're measuring it. From there, we net out our interest expense, which brings us to our taxable income, how much the company can get taxed. From there, we net out our income taxes and arrive at our profit or loss. Right? So when people talk about adding value, instinctively, it's to say, are they generating profits? Right? And as we've already talked about a little bit, and as we'll talk about in more detail throughout the course, there is a difference between cash flow and profits, and cash flows are a much more accurate measure of value being created or destroyed. So profits can be the starting point for value being added or destroyed, but it is not the end. Profits are where we start estimating our cash flows from in the bottom-up method. It's not where we conclude. All right, so this is the typical structure for the income statement. And lastly, we have the cash flow statement. This is a little simpler even still. We start with our operating cash flow. So cash flow generated from operations of a firm. Again, a lot of times the name is the definition itself. Really nice thing in the field. Then we net out our investing cash flow. Right? So money that was used, spent on capital expenditures or received from selling assets that the company has already made. And then financing cash flows. So money we might raise from issuing debt to money we might use to pay dividends or paying off debt. This is, again, the typical layout for cash flow statements. There are a lot more details in actual financial statements, as we're going to see, and as you'll see as you go through your project. But it's the same general structure, and it's important that you generally understand the structure more than each individual line item. Line items change across firms. What's important to understand is what those line items really mean in the grand scheme of things. Grand scheme of things, what we're trying to get at is the cash flows that companies are generating. All right, and lastly, we have the statement of shareholders' equity. Not really as important. It reflects some information, nothing that is necessarily going to be used for any valuation purposes, but it can be just a quick reference for some relevant information, contributed capital, money that's been raised or retained through previous profitable years, and retained earnings. All right, so how are all these financial statements related? In a way, cash flow is basically what is the through line through these financial statements. All right, so specifically, the income statement connects to the balance sheet through net income. When companies have profits, they can choose to either pay those profits out in dividends or retain them within the firm and put them into retained earnings. All right, so income statement connects to the balance sheet through net income. And then our cash flow statement is what brings all these together. So our cash flow statement starts with information from both the income statement and the balance sheet. Right? We have net income, which is the bottom line of the income statement, and depreciation and amortization. Not always explicitly laid out on its own, but typically companies will have a depreciation expense that you'll see at least on the cash flow statement. And then other parts of the cash flow statement, we have to get short-term assets and liabilities in order to calculate our change in net working capital. And we need the capital expenditures that companies engage in, also through the balance sheet. Right, so when we're looking at cash flows, we need information from both the income statement and the balance sheet to bring that all together in order to actually get our measure of free cash flow. All right, so a couple quick notes here. I had mentioned in last class that the cash flow statement was required from public companies starting in, I think it was the late 70s, early 80s, because cash flows are less manipulatable than profits. But on top of that, right, that hasn't stopped management from engaging in misrepresenting factual information. Right. So one of the largest motivations for implementing the new financial statement rules of Sarbanes-Oxley was basically accounting fraud. Right. So a really good example of that is Enron. If you haven't looked up Enron, I have a good documentary I forgot the link for, but I'll post it in D2L. Basically, the company was engaged in widespread fraud. It was a very large, prominent company for a while, and then when information started coming out that they were basically just fluffing their numbers, not actually generating not only any value, but losing, just tearing through capital that they're raising, this led to a lot of outrage because basically the entire point of financial statements is to convey information, to understand the reality of these firms. If capital providers, if investors can't understand the firm because they're intentionally being misled, that can be a really big problem for financial systems. All right, so that basically led to the result of the Sarbanes-Oxley Act, which now is putting a little bit more skin in the game for executives, particularly the CFO and the CEO, who now have to personally stamp and can be held accountable for actual misstatements or intentionally misleading investors. That doesn't mean that financial statements still aren't presented through a positive lens typically, right? Management are doing a better job trying to present challenges to the company, but generally speaking, it's in their best interest to have financial statements as profitable as possible because that's how their compensation is typically tied. So we still see in the leeway that they have in managing their financial statements, it tends to skew towards a positive result. It's also important to keep in mind that financial statements are still estimates. As you're going through and gathering financial statements for the company that you're going to be looking at, you might see that the company is engaged in restatements. That is very typical for companies. Right? There's a lot of information that they have to gather to put their financial statements together. And you'll see that in the future, as they continue receiving more information about previous years, they will update those financial statements with the more accurate information as they receive it. So financial statements are all based on assumptions, right? If you're making an estimate, there has to be some assumption going on. And we'll talk about some of those throughout this course. One thing I always like to point out, though, is just to keep an eye on companies that are lumping abnormal expenses. This is one of the common ways for executives to try to basically bury poor decisions, right? Something that companies have a little bit of leeway is on their depreciation and expensing off capital expenditures. So in the extent that they have that, if they lump up a bunch of those expenses in the same year, it's not uncommon to see executives make the argument, oh, this was just a one-off expense. It doesn't necessarily reflect our average profitability. But yeah, if companies have leeway to do that and management do engage in that lumping of abnormal expenses, if you average out those abnormal expenses, as should be done, often you'll see that they are generating much less value than they claim. One important thing that we'll also notice is the value of footnotes. Right? Very often when you go through and read something, you might just skip over the footnotes, right? If it wasn't worth putting in the body of whatever you're reading, why bother looking at a footnote? But there is value contained in them, right? A great example is how companies measure cash flow. Companies have discretion over how they measure free cash flow, and usually that's going to be buried somewhere in the financial statement. You'll see a little note. This is how we measure free cash flow. There are these alternate measures that you can use to estimate free cash flow. Right, so footnotes have a lot of information. Management discussion and analysis does as well. Right, management are doing a relatively good job talking about what they think the upsides and downsides in the current economic environment are for their company. So there's a lot of information in there as well. Right, and also when we get auditing reports, there's also information about valuable information about the firm in there as well. All right, so the typical steps that you will be taking when you start financial statement analysis, you're going to be starting off with, what's the point? Why are we gathering this data in the first place? Usually it boils down to valuation and funding. How much is something worth? How are we going to be paying for it? right? So on the investor side, you're concerned with, is this company generating cash flow? On the lender side, is this company generating sufficient cash flow to pay for these additional costs? Will this debt be used in a productive purpose that it is still likely to be recouped at the end of this project's life, right? So it's important to understand the why of what we're doing, which is generally, is this a good decision that we're about to make? Then we start gathering the data. Thankfully, this is all public information. There's a lot of resources that we have available to us to get this information gathered. But figuring out what is the relevant data, what's extraneous, and what's actually getting to our objective is the next step of actually just going through and processing the data. What's relevant? What do we need? From there, we can actually engage in our analysis. So applying our cash flows, applying our time value of money. Very often you'll see that financial statements aren't adjusted for time value of money. That's on the shoulders of the investors, of the people analyzing the company. Right? And from there, you get your conclusions and your recommendations. Should you make the investment or not? Sometimes it's close, but very often it's a pretty clear difference between what the cash flow is and what it should be in order for this to be a good decision. Right, and lastly, and this is the step that most people forget about in real life, is updating. Right, once people make a decision, they tend to stick with that without making any updated changes or beliefs about what's going on. But the economic performance of companies can change over time. Right, so what may have been a good decision in the past is not necessarily a good decision to make today. So it's always important to go back and update your information and really evaluate, am I still making the right decision? All right, so you're going to be basically tying together the information that we're going to be talking about in order to make decisions. That's the goal here, right? When you start your job, you have to be able to make credible decisions, and that credibility is largely going to come from your ability to go through financial statements, get relevant information, and put it together in a useful way. Put it together in a cash flow table. Right? We're also going to consider how investors might be interpreting this information. Right? When you're looking at your investment portfolio, typically the best thing to do is just passively invest in low-cost ETFs. But right, being in this field, there might be some personal value in trying to figure out specific companies to invest in over time. Right, so how are investors going to use this information? And then how are the two related? Biggest way they're going to be related is basically through free cash flow. Everything comes down to that. All right, so throughout this course, you're going to be able to put together financial statements. You're going to be able to find where to get the relevant information to put those financial statements together. Use that all to value companies and really just understand what you're looking at. Like I mentioned, there are general structures we're going to be evaluating, but there are specifics within each company that might be a little bit different. Those specifics, they are important for that specific company, but they're not necessarily relevant to the broad scheme of how we understand value and put information together. You are going to be working in teams. I'm going to be sending you the group that you're going to be working with for the last stage of your project. I'll send you that by the end of the day, along with the companies that you're going to be evaluating, and also being able to put together well-written summaries. Right? And basically, those summaries are just going to be short, 1 to 2 pages of information expanding on the motivation for what you're doing. Right? So putting together those summaries is really important because, right, as you start into the field, typically you're reporting this information. They just want bottom line summaries of what is going to be doing. What's the good decision to engage in? All right, so this class is going to be difficult. One of the other things I like to typically start off with is just trying to motivate, right? People tend to go to school to improve their career advancements, learn some stuff. And over time, we see that that has tremendous value, right? So at this point, you all have at least some college, right? So the marginal difference might be whether you're going to finish your associate's degree. Really, you're going to be leaving here with a bachelor's degree. And basically what that translates into is about a 40% pay raise over your other opportunities available. One thing that this doesn't include is the distribution of earnings across college majors. Typically business and STEM, particularly engineering and medicine, those are the 2 largest paying areas. Right? So being in this field, it does take a lot of work. There's a lot of upfront costs and cognitive load and just learning to understand what we're going to be talking about. But over the long run, it's going to be worthwhile because this translates into about a 40% pay raise on average, even more when you adjust for the field that you will likely be working in. One good specific example of this are financial managers, right? This is one of the largest growing career paths that people engage in. The mean is a little bit skewed by the higher end. If you look at the median, that's a much better method of understanding the pay distribution. But if you look at the median salary, is about $131,000 a year. Right? And that's the sort of opportunity that's available to people who actually understand this stuff by the end of your degree. If you can put together financial statement analysis, if you can convince people that you understand how to evaluate a company, you're going to have the ability to interview and apply and get jobs in this sort of field. Right? And this isn't a hypothetical. This is one of the common goals and starting places for a lot of people that come out of our programs. So make sure that you understand what we're talking about, because it's not just an exercise to test you and work your brain out and stuff like that. This is information that you're going to be using. So it is going to be a lot of work. It is going to be difficult. But if you want access to these sort of career opportunities, likely it's going to be worthwhile then. All right. So if you want to explore different salary options, I definitely recommend checking out some of this information here. The Bureau of Labor and Statistics keeps information on all the different fields basically in the United States. Again, this PowerPoint is posted on D2L, so you can just copy the links there. But if you just search up BLS wage data, that'll start getting you in the direction of what you're looking for. I strongly recommend, if you're considering different career paths, look out what the average salary in those careers are. Your career path choice is probably the largest determinant, as well as your level of education. So where you choose to work is going to be a huge determinant of how much you earn. So look at different things you're interested in. If you're tied between a couple of different fields, go with whichever one tends to pay more. Right? That typically tends to work out pretty well. So next time we're going to be talking about financial reporting and getting into some more details for financial statement analysis.